Father, we thank you so much this Lord Day, and again, thank you for this community. We thank you for these board members here that commit their time, and also the staff, and to glorify your kingdom. God, we ask that you would open our minds and our hearts up, Lord, to listen to what our community needs are, Lord, and give us the wisdom to do what we need to do to make this a better place and again glorify your kingdom. Now, please be those who are not with us, but hedge protect around them. And these things we pray in your name. Amen.
Amen. Thank you, Rusty. Let's do roll call quickly. So we have Rusty.
Here.
Rich is not here. Dr. Fasudovin?
Here.
Okay. Ken?
Yes, ma'am.
Dr. Harold is not here. Harvey?
Here.
Here, and Teresa's here. Okay, good. Do we have any public comment? Okay, hearing no public comment, we are going to move into the approval of the previous minutes. I hope everyone has had a chance to review them. Any questions? If not, we will take a motion to approve. We have a motion by Harvey. We need a second.
Second.
And we have one by Ken. All in favor?
Aye.
Motion is passed. All right. Kurt?
So I'll provide a brief update and pull out 2 items out of my written update that I thought would be of interest to you. So last year, when we were preparing our budget and we were going through some of our workshops to add 2 new health pillars to the hospital district, prevention and early detection and unintentional injuries as one of our key areas. One of the data sets that I pulled out was the leading cause of death and serious injury in Marion County, non-chronic disease related, was related to falls for the elderly in Marion County, since we have such a large population of elderly citizens. And as we've been evaluating what our role can be in looking at evidence-based research on how we can mitigate falls, we came across a group that formed late last year about the same time that we were having our workshop, and it's the Marion County Fall Coalition, apropos. And there's 2 key partners that are in that are leading this. One is the Marion County Department of Health, who is a good partner of ours, and also HCA. They have a division where they are trying to reduce traumas that come into their hospitals in Marion County. And the interesting thing is they informed us during our initial meeting with the Fall Coalition that 50% of the hospital's traumas in Marion County at HCA are due to falls, which was interesting because it's a very high number. And so we just wanted to let you know that we're meeting with the coalition. There's several members on it, and each one has carved out a role that they're doing. A lot of the interventions that are evidence-based that they're trying to pull in from other models throughout the country focus heavily on education for the older population, helping them with medication management because misutilization or not taking appropriate medications or interactions cause dizziness and cause falls. But also they're doing, working with Marion Senior Services to do home safety assessments and evaluating trip hazards and also evaluating key places where they could put in protective gear, where they could like grab handles in key areas. So we're participating so we can evaluate what our role is and how we can expand the services. And one of the focus areas right now, one of the leading areas of serious falls is the villages. And so that's where they're trying to start their model on the Marion County side. And so just an FYI, we're working on this, and we'll bring a plan as to how we can assist the coalition.
So, can you be more specific on on the age of the elderly population?
So the interesting thing is that it starts at typically about age 55. They're seeing the traumas.
Really?
Yeah.
For falls?
Yeah.
Ken?
Hey,
I won't push you.
I'm there. there.
All break your hip.
55.
Yes,
55 sounds kind of low.
you would think
All
so.
young.
For real falls that I see, it's in the 70s and 80s.
That is a significant population, but the surprising thing with the dead is it begins it's, if you look at the bell curve, it jumps significantly around 55.
And the village's population is young. They're very, very active, so maybe that's the reason.
And that could be it.
Yeah.
So then, the other interesting thing is I was looking into working with our older population in Marion County. One of the areas that I've been trying to focus on is most of the services for Alzheimer's and dementia patients in Marion County are focused on palliative care and respite care. And so I've been digging deep, working with a couple researchers, looking at, is there anything we can do for intervention, for treatment and prevention? And it's very interesting. So the research led me to the University of Florida, is one of the 3 leading research institutes on treatment for dementia and particularly Alzheimer's. So they have and I'm gonna, right after this, tomorrow at the latest, I will send out a white paper to you that kind of goes through the analysis of this treatment. And basically, there's an enzyme, a protein that all of us have in our bodies. It's called klotho, K-L-O-T-H-O. And when there's an overexpression, there's excess klotho in your body, you tend to have a protection against both dementia and also against Alzheimer's disease. And it's not only a prevention, but it has been found in the early stages to be a potential very promising treatment. So I'm working to get with the lead researchers at University of Florida. So, and
They're about Aaron Campo. You know Aaron?
that name sounds familiar.
Red Star Research. They're doing some clinical trials on Alzheimer's products currently.
Okay, I'd like to, so so what I'll do is I'll send that white paper out to you so you can see who the lead researchers are, what they're working on, and for me, it was one of those areas of aha where they were so far ahead in these clinical trials, working with 2 other universities in the nation, that I thought if we could at least bring the trials here and we can encourage them, I thought that maybe we could bring some of these early interventions here in Marion County. So I'll share that. I just want you to have that, and
Is there a financial impact to it for us? Or is it just an extension of the research from there?
don't know yet. We'll see. I believe some of the research funding came from the National Institute on Health, so it just depends on if they've been impacted with any potential cuts. So I'll find out from them.
Okay,
That's all I
is that
have.
it for right
Thank you.
now? Okay. All righty, thank you, Kurt. That's very interesting information. So let's move on into investments. Hey, Steve.
Hi, everybody. I'm Evie, here from Wilshire, along with my colleague.
Is her microphone on?
Oh, let me just stand closer. Is this better?
Yes, on.
It's on. I'll play that.
Okay. Here from Wilshire with my colleague Megan, who you know very well, and good to be back with you all again. Today, I'll kick off the investment portion of our discussion with a brief market overview, and then I'll give you an idea of how the total fund is positioned and has performed over the past quarter. And then Nathan's going to take over to discuss longer-term results. He'll share, peer performance, so you can get an idea of the context and where you fall there, and then the growth of the corpus. And then after that, of course, we'll turn it over to our colleagues from Truist, Crescent, and Greystone to discuss the details of their respective portfolios.
See if it works. Just point it at me.
Right. Two things to there. We'll stay on the landing page. Okay. So please feel free to stop me along the way if you have any questions. But I figured given a lot of the crazy headlines we've had over the past few months, it would be good to spend a couple of moments on markets and econ so that you can see how it's informed a lot of the strategic thought that we've put into how we've positioned your portfolio. So looking at some of the economic highlights, the headlines have clearly depicted a lot of chaos going on, and hopefully you'll walk away from our comments with a feeling not so panicked and that we have a plan and a vision in place. So looking at some of the things like GDP, inflation, and interest rates, which are a few key indicators, I want to start by zooming out, looking at the current GDP story. We know tariff uncertainty has really triggered a recalibration of the U.S. growth outlook in general. And post-Liberation Day, we saw that GDP forecasts were generally revised downward, along with expectations for inflation going forward to be much higher. And of course, lower growth and higher inflation, which is something you'll often hear referred to as stagflation, creates this perfect storm for a recession. And that's now a growing concern among investors. And interestingly enough, if you do look at consumer sentiment data and drill down there, most consumers will tell you that they feel okay today, and the employment numbers are still, strangely holding up. We haven't quite seen a softening there, but people say that they're increasingly worried about tomorrow and what's to come. If we circle back to inflation, thinking about what's driving that anticipated increase, the increasing import costs from tariffs combined with a weakening U.S. dollar that we've heard so much about does translate into higher goods inflation, and that's on top of the already higher services inflation that we've been experiencing for quite a while since COVID. So markets are pricing in all of these factors and anticipating that the Fed's going to end up having to cut rates a few times this year. But again, I feel like just a year ago, I was up here telling you guys it's a sticky situation. The Fed's in a pickle because now they have to factor in the tariffs on top of all the other things that they were thinking about, like employment and inflation stability in general. So as we think about the U.S. equity premium or U.S. market dominance that we've seen for such a long time, we could be operating in a new regime. We've already seen that regions globally that have the least exposure to U.S. revenue have been less impacted by revisions to their earnings or downward revisions of growth forecasts. And companies like the Magnificent Seven, which again I know we've talked so much about, that have really inflated those U.S. profit margin growth over the years, we'll see their margins squeezed under the new tariffs, and this equity premium could come under pressure, and we've already seen that happening year to date. So now I'm going to flip to page 9, which is our market commentary. Just want to hit a couple of regional highlights here. Looking at U.S. equities, the U.S. market was down about 5% for the first quarter, but it's still up 7% over the past 12 months. And I think it's important to highlight here, as I alluded to before, two of the largest sectors that were down double digits were information technology and consumer discretionary, which is quite a turnabout from where we were this time last year. Looking to non-U.S. equity, year-to-date, Europe and emerging markets have fared much better than the U.S., and that's largely due to increased spending in Germany and stimulus measures going on in China that have had a positive impact. Hold on for a second. And then the U.S. Treasury yield curve was essentially down across most of the maturity spectrum, and right now the consensus is that there will be 50 basis points of the Fed rate cuts this year. But again, a lot of debate over when exactly that's going to get started. Looking forward, I want to take a step back and thinking about your portfolio. So if we take this backdrop that I've painted for you and we think about how we've strategically positioned the portfolio, this quilt graph that we have here, I know it's probably a little hard to read, it essentially shows you the asset classes in terms of, best. Yes, love a good quilt graph in our industry. It shows you the best asset classes to worst. And the interesting thing here is U.S. equities, but U.S. equities specifically, have typically produced outsized returns for such a long time. If you take that graph even back further than 2020, you're going to see consistently it's U.S. equity that's at the top. And the asset allocation work that we did with y'all 18 months ago when we first got started really did help to put these returns in context and inform the strategy that we wanted to drive going forward, which was to diversify the portfolio further away from equities in anticipation of these lower returns going forward, which we're now experiencing. So asset classes like private credit and real assets are areas of the portfolio where we do see opportunity to gain more yield for you while still earning attractive returns. And then again, the most important thing is their ability to provide some inflation resilience, which is going to be important going forward. So if we move forward, yes, here, to touch briefly on the total fund portfolio positioning. We did transition to the most recent iteration of your investment policy as of the end of December, so the top of this year. And if we flip to, let's see, actually, we can see here. You can see that we're pretty much on our way to being in line with where we're trying to go. But of course, there are still a couple of categories that are currently out of compliance, which are denoted by those yellow triangles. And you'll have more details on that when the providers do their overviews a bit later. If we move to performance attribution for the first quarter on page 15, again, we can see that the total fund was down by 13 basis points over this period versus the policy benchmark of 47 basis points. And at the top line, most of this underperformance did come from an asset allocation effect, which was, the total fund being slightly overweight to U.S. equities versus the policy, and then we know that U.S. equities have underperformed over this period. So it did detract from total results. And again, there will be more to follow on the performance details from our colleagues. Let me turn it over to Nathan to continue our discussion with a look at longer term results.
See if I'm as adept at the clicker. Is that working? Oh.
You got it. Press it.
Okay. So as Evie said, I'm going to just focus a little bit more on the longer term returns, and then I'm also going to talk to the trustees about more strategic items and recommendation of holding a workshop later in the summer to cover a number of those. So when we think about relative performance, that's what we're showing here, not necessarily how much did it return in dollars and cents, how much did it return in percentage points, but whether or not collectively your three OCIOs outperformed or underperformed the benchmark. There's two primary ways that happens. There's what you see in green there, which is the effect of being overweight to US equities or underweight to private credit. So there's all of those allocation positions, and then there's the orange positions, which is active management. Are you selecting a manager within each category which is outperforming the general? And so when we zoom out from a 3-month to a 6-month period, and this is what tends to happen, but not always, over longer time periods, the impact of green goes way down, and the impact of orange tends to go up. It tends to be manager selection which drives outperformance or underperformance. And again, I'll leave the details to them to avoid being redundant. But as you know, and what we continue to talk about when we present is even 6 months is a really short period of time in an investment period. So when we think about assessing the success of this investment program, really we want to go back as far as possible. Now, the aggregate data that we have here on slide 15 only actually goes back to 2015. Obviously, a number of the providers have been around for far longer than that, but in terms of actually aggregating the data, it's only 2.5 years. Now, contextualize, because frankly that's probably 80% of what we're really trying to help the trust board with. What are we trying to achieve here investment-wise? We're trying to achieve CPI plus 4, so we can give out 11 and hopefully more and more dollars in future and exist forever on an inflation-adjusted basis. We're trying to beat our benchmark, and if we do number 1 and number 2 correctly, we should beat our peers. So over that 2.5-year period, the aggregate portfolio returned 10.8. So yes, that's achieved our strategic target. Versus benchmark, we are lagging a bit. Not a huge amount, but we're 1.11% behind benchmark. And then when we look at the peer group, and again, we only have this over 2.5 years, generally what we are seeing is the benchmarks or the strategic targets multiplied by whatever benchmarks are kind of tracking or slightly ahead of the median foundation which we're comparing you to. We just had a conversation with Mac. There is no perfect peer group for MCHD. You guys are just too unique. But in terms of the way your investment program is actually positioned, you're most similar to a foundation. So when we look at 450 nationwide foundations, you can see there, and again, we focus on the left-hand side because that's the most impactful number. The benchmark ranks sort of 61st percentile, so not up to median, but when you look at the shorter term periods, it's actually much, much better. But we are seeing a bit of drag in aggregate from active performance. Final slide on performance.
What's the difference between the square and the circle, the total fund composite and the total fund policy?
Yes, so the square is what you've actually achieved. The circle is were it to be possible to be 100% passively invested and just achieve the benchmark returns in every single category.
Based on our investment policy?
Yeah.
Okay.
That's what you've achieved.
Let's do that.
We're working on it. Final slide, and again, we've been through this, but and I really want to double click on this, in the face of heightened uncertainty, let's not have a knee-jerk reaction. So when we look back at the longest data we have, was not perfect for a whole bunch of reasons that we previously discussed, we are, the dark blue line which represents the spending is still outperforming the inflation-adjusted corpus. Let me just say that again. Over a 10-year period, the success of the investment program after spending has still outpaced inflation. What we are focusing on now and what we have much better data and transparency now is like that last 2.5 years of it, okay? So just for kind of contextual purposes. And then the final thing I wanted to mention, as you know, we've been working really, really hard, and the OCIO managers have been working really, really hard to provide a number of qualitative inputs for us to assess the depth, the breadth, the quality, the transparency of all of the elements of their process that they bring to you to provide both those quantitative numbers, which definitionally are backward-looking, with the qualitative numbers, which are much more forward-looking and much more representative of the quality of partners that we want managing money for your portfolio. Rather than talk about it here, because you can see we've already struggled to keep to a 10-minute time limit with something as simple as a performance report, to try and do that with like a 70-page DDQ is impossible. And we also think about, what is the sort of strategic work Efi and I have done since we've been brought in over the last 18 months. Well, we've created this dashboard with their partnership and with your help. We've run a forensic fee review that we're going to be refreshing over the summer. We put a new strategy in place that Efi said we've got more conviction in now, frankly, than we did 18 months ago. We want to hold a strategic workshop that we have more time, and also, frankly, to have an environment that we can really hear from you on how do we take this forward. Like by then, and we're thinking kind of August, September time, we will have done 3 or 4 of these quarterly dashboards. We would have done 2 of these forensic fee reviews. We will be refreshing our strategic analysis to make sure we're still on track with our targets. And so what we'd kind of like to hear from you collectively as a trustee, and so please feedback by Kimberly, by Deborah, by Kurt, by Teresa, to us is when works best. And also, I know we've done kind of hour and a half long individual training sessions. If any trustee values that, wants a refresher on that as we move to another dashboard because it was probably drinking from a fire hose, then please let us know and we'd love to do that.
Okay, thank you.
With that being said, I'll pass it to Mike from Trust.
On the workshop, how much time do you think we would?
Hour and a half.
God, that seems light.
2. I think, I've got a good idea in my head from our side. I want to be respectful of your time, so always the more time on this, the better, because the different confluences that we need to bring together and have a good, robust discussion.
That's something that we're gonna plan for late.
I think the plan is late
September,
August
October,
slash October, but outside of the regular meetings, because it just doesn't work with the government to a 10-minute discussion.
Right. And we'll work on that.
Yeah.
Thank you. Hey, Mike.
Hi. Good afternoon, everyone. We're good, surviving the first part of the year. Certainly not what we woke up January 1st thinking that we were going to navigate through. It's been a little bit, but I think we're navigating through it well. And Nathan and Evie, I think, really summarized by saying it's not the time to overreact or do any knee-jerk reactions, and that's certainly something we haven't done. There's a lot being floated around, but there's very, very little certainty, right? And I think that's what investors are nervous about and waiting on. We've seen more volatility in the bond market, and I've been trading bonds going back to when I cut my teeth in this business in the late 80s in the past quarter than I've seen in my career. And when bonds are that volatile, I think that that's a clear indicator that global markets are very uncertain with regard to what policy changes are going to be implemented from the U.S. I think that's why we've seen the dollar, right, significantly pull back over the last 30 or 40 days. The benefit there has been to international equities, kind of almost a reverse of what we experienced during the fourth quarter. So from an asset allocation standpoint, we've got all the information in the deck. Really haven't shifted much other than to keep up with the evolving, right, ranges and targets that are being intentionally implemented by the Wilshire team. So to give you a high level, want more than anything to be sure that I answer questions as it relates to how we at Truist are thinking about the markets. So just a couple of things that I will point out. Following along in the presentation, page 3, always a good high level check-in. So as it relates to portfolio construction and the mandate that you have for us in full compliance with all of the asset classes, again, continuing to make some changes tactically to get closer to targets. Some of these take a little bit longer than others, but clearly within the allowable ranges. So from an IPS standpoint, looks good. On page 5, high level for performance for the quarter. So this would be January 1 through the end of March. Portfolio was down 90 basis points net of fees. For the trailing year, up about 5.25%. What worked during the most recent quarter, real assets, fixed income, cash equivalents, international equities. What didn't work were U.S. equities primarily, and in particular, large cap growth probably underperformed the most, right? Almost a mirror opposite of what we had last year, kind of like with international equities posting big returns that are mostly dollar-based. About 80% of those returns are dollar-based. When we look at those in local currency terms, that return is not nearly as strong. Important to keep in mind, because depending on what gets said about policy and what gets enacted, the dollar can reverse pretty quickly. Within fixed income, the last time we were together, we talked about the strategy that we have in place, which is intentional, and it's what I would refer to as a duration shortener. What that means is, in addition to the intermediate high-quality fixed income that we have in the portfolio, I also have a large allocation to 1 to 3 month T-bills, right? Just capturing that 4.25%, 4.3% to help us dampen some volatility. When bond yields are falling, like they have recently, that's going to work against us on a total return basis. When interest rates are rising, it works to our benefit. So just kind of keep that in mind. We intend to leave that position in place until the Fed reduces interest rates additionally. So maybe in June, that's the next expected FOMC meeting that the Fed is predicted to cut interest rates. Time will tell. A lot of information can come out between now and then. Let me pause there. I know we've got a full agenda. See what questions anyone may have with regard to how we have the portfolio constructed, or just economy in general. Lots in the portfolio.
What's Trump's agenda for the next 100 days?
What's that? I'm just,
What is Trump's agenda for the next 100 days?
I wish.
I think we're discussing it.
Right. No, well, I mean, we can have fun with that, but it'll still be nowhere close to what reality will be, right? A lot of uncertainty.
I'm just curious, I'm not real smart, the market seems to react to tweets. Is that just in this presidential administration, is that, I mean, his tweets seem to, well, mainly about his comments about Chairman Powell, seem to have a huge impact on the market, but the fundamentals of the market, balance sheets and income statements, really haven't been impacted by that information. Is that normal?
Is it normal that we have a president that tweets a public fight against the chair of the Fed? That's not normal.
Okay.
No.
Okay.
I don't think there's been any other president that tweets.
I guess it seems to me that all this noise in the system is hopefully going to be temporary and sort itself out of the time. So,
But I think that that's the hope of all investors, right? And as was stated earlier, you know, if we look at the key metrics that the Fed follows, right? Inflation, PCE, which comes out this week, so we'll get an updated view there. The unemployment rate, right, which still pretty low, not seeing significant changes. GDP, there's a lot of noise in GDP because a lot of physical gold moved during Q1, and particularly the Atlanta Fed's GDP report could be skewed. We'll get more information on that as well. But I would say economy-wise, kind of to your point, pretty healthy.
yeah.
Wages are still rising, but there's a lot of confusion around sentiment. And sentiment can really move the needle over the short term. And I think that's what we're experiencing, right? A lot of volatility in PE, just investors, business owners, our trading partners around the world, other countries, don't know how to position for what's next because no one knows what's next. Fun times.
Yeah.
So hanging in there really well. Really like the work that EP and Nathan are doing. Hopefully we're doing a good job getting information back to you. I know we have a lot of calls together. But pleased with how the portfolio is performing.
Thank you, Mike.
Thank you.
Appreciate it.
Hi, everybody. Adam Palmer with Morgan Stanley, Greystone, TJ Lowe. My comments will be more high level, and then I'll ask TJ to come up and kind of dig into the attribution report and show some areas through allocation and specifically manager selection that had some outperformance and some additive nature to the portfolio. But as far as quickly on the economy and the markets, I think we're very close to being in line with Wilshire's comments and True's comments. You know, uncertainty is the word of the week, might be the word of the year, and we view it as a chessboard of uncertainty. As pieces of that uncertainty come off this year, so if the tax package is passed, a piece of uncertainty comes off the board. Tariffs are announced, some uncertainty comes off the board. The more uncertainty that comes off, we think the markets will settle down, and we think the second half of the year could be really good. And you have the uncertainty of policies that are out of the box, aggressive tariffs that are out of the box, things that have never really been done before, but then you have the added uncertainty of our president, whether it's tweets or he's going to do tariffs to 100 and then he pulls it back a few days later and then increases this. I mean, so there's a lot of uncertainty, and we would totally agree it's not the time to be making significant overweights, underweights, and changes in the portfolio. That being said, we feel that your portfolio, managed by Morgan Stanley Greystone, is well positioned. It weathered this quarter very well, we believe. We think it's well positioned in the future to handle not only the uncertainty we may have right in front of us, but then to recapture the up once we have the recovery and the markets come back to all-time highs, which we do believe they will. May not be soon, it could be 12, 18 months from now. We do think it will recover as it normally does. We're on page 5 of the performance report. This is normally the page that I view quickly. So if you look on page 5, you'll see on the left-hand side, you have the manager annualized performance. We have 1 month, so slightly behind our policy benchmark for the month. minus 1.49 versus minus 1.46 on the policy benchmark, 2 basis points difference. Quarter to date though, happy to have a positive performance for the quarter, up 0.63 versus the policy benchmark, up 0.27. And then if you look at the 6-month return, relatively flat, down 0.07 versus down 0.16 for the benchmark. And then if you go to our inception, which is October 1st of 21, up 5.49% to 4.04%. So a little bit better since we took over this part of the fund. The bottom 2 pages, if you look at total fund, we just talked about that. So your portfolio takes less risk than the benchmark, which is by design. That's how we construct the portfolio to weather periods of volatility like we're seeing right now. You'll see that the maximum drawdown. So during the periods of volatility we've seen, the lowest down that the portfolio has experienced is minus 13%, versus the benchmark was minus 17.08%. So that's also by design. We're capturing close to 100% of the upside, so 96.96%, 97% of the upside, but only 91.87% of the downside. So it doesn't feel great when the market goes straight up. We've had some years like that because we're going to lag in those markets, but when we do have periods of volatility, which we tend to do every 2 or 3 years, the portfolio should look really well. So just a couple highlights, and I'll leave it up to TJ. We do feel like we're well positioned in the portfolio. We are in compliance buying this private real asset, so we do have some legacy alternatives that we're trying to get out of as fast as we can. TJ has an update on that. We are happy with the manager performance. You know, we have 7 active managers in the traditional space. 5 of those 7 have outperformed since inception, which we're happy. We still have a few legacy alternatives like we talked about. And then TJ's going to review the attribution report that shows where we had some additions and subtractions to the portfolio.
Great.
Thank you.
Thanks, Adam. Good to see everybody. TJ Lowe, Greystone Consulting, and I'll kick it over to page 13, go through this real high level. We've got a lot of details in there. We'll skip individual managers and really talk high level of where we're changing. And on page 13, that's our allocation. And Adam just talked about we're in compliance now with at least all the core asset classes we have. At the bottom of that page, you can see just over diversified marketable alternatives, we have private real assets. That's a real estate fund that we continue to have from the prior consultant. We were hoping for liquidation last year. We were hoping for liquidation this year. I checked in with the manager, and they punted and got limited partner approval to punt it out another year. Now, they do that for the benefit of us. They say, look, the real estate market has been soft. As we know, we've seen it slow down a little bit. Rates are high, have been high. We haven't seen those come down. They were hoping rates would come down this year so they can come out and sell this portfolio of real estate. But since rates have not come down, there's some softness in the real estate market. They had, again, limited partner approval to push this out for another 12 months, hoping to sell it 12 months from now. So that's the one part of the portfolio we are out of compliance with, out of our control, out of our hands at this point, but we take that into consideration when we look at the full allocation, looking at private investments, private equity, and private credit, a little bit underweight. But going forward, to fill in private credit, we're working on a drawdown structure right now. Gallup liquidated in January this year. That was another legacy position we had. So with that liquidation, we added a few evergreen funds, which are ongoing type of funds, while we were in search of a drawdown structure, which take more time to invest in. We found one of those. We're working on adding that to the portfolio here in the next month. So we're adding to private credit here, and going forward, we're working towards the year-end goals. I can't believe we're talking about year-end allocation, but we're taking that into consideration as we're working on this portfolio as well. But if we go to the next page, where's our performance coming from? On page 14, this can look just like Wilshire's report from an attribution standpoint. I'm going to focus on a few areas of what's really changed for us over the last 6 months. And it really goes back to Ethy's comments on the Magnificent Seven. It's been such a finite number of stocks that have led the market higher. And if we look up at the top right section of page 14, it breaks it down the same way Wilshire talked about. Asset allocation, value added, manager value added, then some other. If we look for the quarter to date, manager value added was 40 basis points. And if we look at the bottom right section here, you can see green bars. We're breaking down all those different parts of our investment policy.
Those first three sections, those are our growth assets within our portfolio. And you can see that's where the most value for the last quarter have been. And if we go to the next page and focus on that box, over the last 6 months, a majority of our outperformance is coming from manager selection, specifically in the growth space. If we went back over the last year, which is the next page, that's been the laggard part of the portfolio. If you were underweight growth, underweight Magnificent 7, that part of the portfolio was hard for us to perform. When markets change, we're not changing our tone. As markets change, if we didn't see this type of performance, there would be problems. But now that it has changed, it's more in the favor of what we see. We're seeing the outperformance, and with the volatility we've had in May, I mean, in April, we'd expect to see that same similar outperformance for April as well. From an allocation standpoint, if we go one more page from last year, page 16, you can see on the bottom right that again, large growth has been the hardest part of our portfolio. But if we look at the middle section on the bottom of page 16, and you can see what's the biggest drag from an allocation standpoint is that bottom section of private real assets. That's that real estate holding, right? Over the last year, real estate's it's been a tough area of portfolios to be invested in, especially private real estate, and that's been really a drag over the last year. So the portfolio is starting to shift, meaning we're seeing growth assets sell off, and we're getting the protection and outperformance we expect in that environment. Going into the end of the year, adding more to private credit, and then also reducing those equity exposures as the glide path by Wilshire. Any questions? Yes, sir.
I do, and it's, maybe I'm just misreading the graph. So Nathan, you got comparable things in your report, right? And so when I look at the one here for Greystone, 6 months period ending March 31st, it says manager value added is minus 50 basis points. And then I look at what looks like the same thing, and it may just be in different asset categories, but it has the manager value added plus 40 basis points. I'm just trying to, they're both over the 6 month period ending March 31st. So I'm just trying to reconcile what's what.
You know how to make an investment consultant's hair stand on end is ask about data integrity. I think.
Well, TJ's good. He's got less hair.
Now you make me feel even less. Truthfully, truthfully, I think this is something that we would actually need to go back kind of line by line on it. The way we're doing it should be sort of fundamentally the same. I know sometimes there are differences in time as a benchmark, but all of that to say is kind of I don't know exactly right now what's kind of driving it, but we can look into it and come back to the trustees.
Yeah, I mean, if we're, and maybe both are right, maybe neither one are right, I don't know, so it's important to have something that's consistent and meaningful as we're making decisions. Yeah. This
looks great.
A lot better than that.
That's right.
So maybe you can help him figure out, what's different.
Yeah, and they're great and responsive, so I think we have no problem working together to find out what the differences are, and we can keep reconciling, maybe bring that back to the committee and trustees. Any additional questions? Wonderful. Good to see everybody.
Thank you.
Thank you.
Hello there.
Welcome.
Good evening, everyone.
Good evening.
Mark Miller with Crescent Capital. As my colleagues have mentioned, it's been an interesting few weeks since Liberation Day was declared. And unless we reach some trade agreements in the next couple of months, I kind of expect that volatility to continue. So uncertainty is the name of the game right now. But in spite of all this, since Liberation Day through tonight's close, the S&P 500 is only down about 2.5%. So, try to put that, some context on that. So if you guys want to turn to the performance report, which contains our usual monthly report, I just want to point out a couple items. So on page 4, the policy range that we showed here is just the 2024 year-end target. And then for 6 of our private investments, which represent about 10% of the portfolio, we don't have March performance numbers yet, so all these numbers are subject to change a little bit. And although we're going to focus most of this discussion on the past 6 and 12 months, let's quickly look back at the past 5 years, which admittedly began right around the COVID crisis. So on page 7 and 8, you can find these longer term numbers. So the portfolio's gained nearly 9% annually since basically April 1st of 2020, and slightly outperformed the benchmark. Portfolio's U.S. equity managers have returned almost 19% per year, which has outperformed that benchmark by about 0.5%. International equities rose about 8.5% annually. Private equity managers generated an annual return of about 17%. The directional marketable alternative managers, which are largely equity long-short hedge funds, they generated about a 7.5% annual return. Private credit managers have posted an annual return of nearly 11%, which easily surpasses the returns that were available from traditional fixed income managers, which I think it's helpful to remember where we were 5 years ago. So in response to the COVID crisis, we had a lot of central bank and government interventions to basically keep the markets functioning. So in response, the Fed cut their target rate to essentially zero, and then they dusted off their financial crisis playbook by re-implementing the quantitative easing program. So what that did was the Fed's intervention drove interest rates dramatically lower across the yield curve. We saw a 10-year treasury that was about 0.5%. We saw a 5-year treasury that was around 30 basis points, so 0.3%. So all this is to say, it's not surprising to see that the core fixed income returns are only about 0.4% annually for the last 5 years. Again, much better than what the Bloomberg Barclays Ag did, which was down about 4% annually. Are there any questions before we turn over to the performance addendum? So in the last 6 months, the portfolio is down about 0.5% and slightly underperforming the benchmark. U.S. equities have held up better than the overall benchmark, down about 1.8%. Some of our income-focused managers, Callodine BDC was actually up about 8% over this period, and Callodine's equity income fund was essentially flat. The international side of equities slid about 3% and underperformed by a pretty decent margin, a little less than 1%, and most of that's largely due to the emerging markets funds, which are down about 5 to 7%. And despite the recent struggles, we still like the funds, and they're still up about 20% since we initiated the purchases about 18 months ago. The private equity returns that you see here of 22 basis points, those are very muted, but to be fair, none of the investments have actually reported through March 31st. So if we go back to the common time 6-month period that ended in September, the private equity investments were up about 7% versus the benchmark's 4% return. And then private credit did very well, generating a return of about 2.3%, outperforming the benchmark by about 0.5%. But we don't have Q1 numbers for the entire asset class. So if you look back to how they did through December, the private credit managers were up about 3.25%. And then the really difficult spot for the portfolio was the directional marketable alternatives, equity long-short managers. After outperforming by about 10% in this period, in March 2024, directional alts fell about 3% and underperformed by about 5% over the period. The good news is we redeemed a significant chunk of these investments. We redeemed about 3.1 million as we headed into 2025. And then it's not showing here, but we redeemed another 1.15 million, so 4.25 million collectively over the last 5 months. So happy we did that because those managers have struggled. The core fixed income managers were slightly negative, though managed to outperform the benchmark. Cash gave us a decent return of 2.5%. Real assets, basically commodities, were up about 1% and marginally beat the benchmark's return. And the diversifying alternatives rose about 3.5% and outperformed the benchmark by nearly 2%. So now if we look back at the last 12 months, we've returned about 5% annually, but have trailed the benchmark by about 1.5%. U.S. equities gained about 7% and slightly lagged the benchmark. A lot of this was the small cap exposure was the primary drag, but the managers that we have selected outperformed their benchmark by a considerable amount, the Russell 2000. And then the international equities gained about 4%, underperforming the benchmark, and that's largely due to those emerging markets funds that were down about 4%. Private equity gained nearly 5, and slightly underperforming the benchmark, but again, we don't have any performance numbers through March. So if we, rewind the period back to September 2024, over that 12-month period, the private equity investments posted about an 11% return versus a benchmark return of about 5.5%. So really happy with the performance there. On private credit managers, they gained over 7% and outperformed by about 2%. Similarly, we don't have the 331 numbers there, but they're still outperforming over the period through December. The directional alts, again, that's our struggle area for the portfolio, trailing by about 10%. Again, this time last year, they're outperforming by about 15% for the year. It's just sometimes, flows reverse, and, sometimes you're on the other side of it. Core fixed income returned about 5, as well as cash. Real assets did the best of all the asset class, returning about 9.5%. And then diversifying alts did considerably better than the benchmark, basically tripling the return. Do you have any questions on the last 6 to 12 months? No.
Questions, anyone?
And then year to date, we're down about 20 basis points. So hopefully we see this start to turn around. Again, uncertainty is really the name of the game right now. So if we turn to the portfolio transitions tab, so pages 22 and 23 really just show a side-by-side comparison of the previous and new classification methodologies. So we're going to focus most of our time really on page 24. Because this is the transition roadmap, kind of where we're going to get to in the future. Since the new investment policy statement was adopted last year, we've continued to make incremental progress toward the desired in-state allocation. For the U.S. equities, we've sold over $10 million to date. $4 million was redeemed from small and mid-cap managers, and about $6.5 million was redeemed from large-cap managers. On the non-U.S. equity side, we've reduced it by nearly $6 million collectively. And as you can see, we're slightly towards the higher end of the year-end 2025 targets. So if we get some strength in the market, then we'll look to reduce, but we don't want to be selling into this volatility, making any kind of knee-jerk reactions here. And then on the private equity side, we're near the lower end of the target. We previously initiated about a $1.5 million position in Partners Group, which provides instant diversification by style, by vintage, by sector. And since we're near that lower bound of the target, we're still evaluating new funds to add to possibly increase Partners Group or look at some of the managers that our due diligence team is currently reviewing. And then on the private credit side, we added about $2.25 million to Cliffwater's corporate lending fund, putting us right in the middle of the target range. And with the increase in target allocation from 2024 to 2025, we'll probably look at adding various strategies to increase that exposure, continue building it out, making sure it's diversified. And then on the directional marketable alts, like I mentioned, we want to gain by $4.25 million. And though it shows that we're out of bounds for the year target for 2024, with the newest redemptions, we should be right in line right now. And then on the core fixed income side, we're right in the middle of the target range. We've added about $3.5 million, and we're probably going to keep the allocation pretty steady, and we've kept it steady since the last meeting. Cash will continue monitoring, just make sure that there's enough funding on hand to support any withdrawals. Public real assets, we've increased that by about $2 million since we adopted the new IPS allocation. And then diversified marketable alts, we've invested about $11.5 million over the last 12 months, including about $4 million since our last meeting. So while it shows that we're slightly below target at 11.94, given the ongoing volatility in the market, I suspect we'll be within policy range by the end of this month.
Okay. Any questions for Mark? Thank you very much. Thank you, guys.
Thank you.
There's no other questions for investments before Nathan shoots out?
Shoots it.
Thank you.
And thank you.
Thanks for having my other case if I try to shoot.
Take care. Thank you.
So following up to Nathan's comments, we will get closer to whether, what time we're gonna have the workshop, how much time the workshop will take.
Yeah,
Or whether we wanna consider maybe a one-on-one. So we'll see about that. We'll have some new board members by that time, potentially, so we'll have to play it by ear.
Is it every quarter or 6 months or?
Twice a year.
Is there a way to?
Somebody,
any scorecard?
is that easier for me?
You know, there's a lot of information on here, but I don't know, is there a way, you know, I guess we can get a scorecard and actually look at a scorecard and figure out how they're really doing?
Yes, and that is
Layman's
what-
terms and-
That is what Nathan was talking about going over with us.
Okay, good.
Yeah.
Thank you.
So, let's move into operations, Rusty.
Thank you, Madam Chair. I'm going to turn it over to Kurt, because all we have is a balance scorecard.
Yes. And I will call Crystal.
Let's just pass the buck.
The dominoes fall, and
So you can go scorecard.
thank you.
Ooh.
Sorry, I just turned it off.
I can talk louder.
There you go.
All right. Q2 balance scorecards. Overall, the hospital district continues to make solid progress toward its strategic goals, with several measures meeting or exceeding targets by the end of the second quarter. Community awareness and programs reach remain strong, with nearly all programmatic impressions, goals met, and new branding efforts increasing the visibility and impact of our work. Notably, staff engagement and professional development objectives have achieved 100% completion, and there has been a significant increase in goal attainment across funded projects compared to last quarter. 5,685 customer satisfaction surveys have already been completed this year. That was a little bit of a struggle for us last year, so it is a good number to have. 1,600 of them are our MCHD programmatic surveys, so those are surveys across all of the programs that we fund. Over 1,200 are SMA surveys, and 2,700 are Heart of Florida surveys. The MCHD programmatic surveys come back with a 97.6 satisfaction rate, which social services and the work that we do, that is not a common occurrence to have that much of that high of a satisfaction rating. In addition to the satisfaction rating, if you are able to go on Mindshare and look at the narratives that our clients, as consumers, are putting in, you will be pretty amazed. I have gone around quarterly to some of our providers. We're constantly talking about customer satisfaction surveys and completion rates. And when I'm auditing them quarterly, I make a point of talking about those narratives, not just for informational purposes, but so that they can share that with their staff. They're doing really good work, and there is not a high prevalence of complaints, which is, again, not something we see very often, especially for residential and detox facilities. So when you have the time, if you have the time, take a look. I think you'll be pleasantly surprised. SMA, they do internal surveys, and they are at 4.47 out of 5. So their ratings are also very high, which, again, that's not usual. 2,700 Heart of Florida surveys, they are at an 80.7% excellent rating. The most significant strength this quarter is the district's success in increasing community awareness and engagement. All major hospital district programs surpassed their impressions goals, and the new awareness strategy continues to make MCHD programs more visible and recognizable through the community. We have a ways to go, but we are on track. Additionally, the district's ability to draw in new outside funding, including over $1.6 million for substance use treatment beds, and applying for another $1 million in domestic violence appropriations funds, stands out as key achievements. The most pressing area of need on our scorecard is what we just got done talking about, which is our financial performance. The investment portfolio is currently underperforming below the 4% target. Continued focus is needing on investment strategy. As well as completing outstanding training and site visits in the coming quarters, we are not concerned with that. Several of our staff are in long-term trainings that take several weeks to complete. In summary, the district excels in outreach, partnership building, and staff development, but should prioritize improving financial returns and ensuring all professional development and program site visits are on track for completion by year end.
Excellent.
Any questions?
Excellent job.
Thank you.
Thank you very much.
QD to go on to the next? I have that as well.
No, you mean the strategic initiatives?
Mm-hmm.
No, we're just going to, if everyone is good, that information is in the packet. I'm going to allow you to read it and then follow up with any questions. Thank you.
Thank you very much.
Okay. So, Dr. Merrill is not here, so as I mentioned, all the reports are in the package for your leisure to read, and if you have questions, get with Kirk or Deborah or any of the staff. So Matt, let's turn it over to finance.
Thank you. In the packet, we do have a set of financial statements which we will go over, but briefly before that, just want to update everybody. As you may recall from last month's meeting, Purvis Gray issued their audit opinion on our financial statements, which was an unmodified or clean opinion, which was great. And then since then, in about a 45 or 60-day window, we have to file a bunch of reports with the state. We have to advertise certain things in the paper. We've reported it, all the various state-wide entities, everything that needs to be reported, and we've just delivered the advertising to the attorneys for publication in the newspaper. So in short order, we'll be fully compliant with all the reporting that happens after the audit report is issued. So that will just wrap up and put a nice bow on September 30th, 2024, keep us in compliance with all the state regulations as well as statutes.
Excellent, thank you.
Now, on the financial statements. You may have noticed they're several pages longer than they've been in the past. And as you may remember also from Purvis Gray's presentation last month, is that the hospital district was operating and reporting in compliance with state objectives. It was. It was trending towards not in the next few years based on the way the operations of this organization have changed so dramatically over the last 10 or 11 years. So with Purvis Gray's guidance, we took upon a conversion of those financial statements from what would be considered a proprietary or enterprise fund, which is more commonly thought of in the governmental accounting world as a for-profit entity. So that's why we would always present a balance sheet and a statement of revenues and expenditures, a statement of cash flow, a budget actual, very common for those of us that are in private practice, not in governmental. However, during this conversion, to issue U.S. GAAP financial statements as this governmental entity, we've also had to change the interim reporting quite significantly to match that of the annual financial report as well. So included in the packet now are multiple statements, and we can, I believe I spoke to everybody about these last month and individually as well, but the basis is this. You have government-wide financial statements, which are the statement of net position and statement of activities. In form and substance, that's your balance sheet and income statement in totality. There's a general fund statement, which has a different focus. It's a resource focus, and that's more income statement driven. So there are certain items not reported on the balance sheet or income statement of that general fund, such as capital outlay or capital assets, the pension obligations, these deferred inflows and deferred outflows of economic resources, the lease, etc. So now we have a statement of net position, which is akin to a balance sheet, and a statement of activities, which is akin to a P&L on the governmental-wide side, and that is totality of the reporting of this organization. Whereas the general fund, which has a balance sheet and a statement, essentially a P&L statement, that do not report everything. It does not report capital assets, so depreciation expense. It does not report lease expense. It does not report certain things that you are more used to seeing month over month. Now, the reason we've got all these pages in here is because in order to be fully compliant with U.S. GAAP on the interim basis, that's what we've had to do. Always open to a suggestion from the trustees if the information is tough to digest, or there's too many questions and you want a different or simplified approach, we certainly can. All that would change is the presentation of those statements and the modification of our compilation report. So with that being said, let's go over these new statements. On page 52 is... No, you got to open that. The fun's about to start. So on page 52 is the statement of net position, government-wide. So this is more akin to what you're used to seeing as a balance sheet, so to speak. It's a little different, but it's more akin to what you're used to seeing month over month. And in this case, we have a significant cash holding, mostly related to the opioid and DCF funding, which has been mostly funded through all of the opioid and a significant portion of the DCF, which are deferrals on the balance sheet as well, as they're not earned yet. So that's a significant change. The cash holdings are up. We also have some large lit payments and things that were going to be paid as part of operations of the organization, so the cash holdings were there.
So the AP is so high?
Exactly. Yeah, there's $500,000 for the DCF opioid that was to be paid to SMA, which is why we're out of line from prior months. That 500,000 is not a one-off. It's going to be recurring in nature, but it's not monthly or quarterly at this point. And then, as briefly reviewed by the investment committee, the investments decreased during the period. So the asset values of those have gone down, and the impact of the P&L is that it's caused a loss from operations on unrealized holding losses. Otherwise, the balance sheet and income statement don't have a lot of changes on the government-wide side. One of the questions I have for the trustees on page 54 is this is the summarized version of the statement of activities, and it's not what you're used to seeing. So get out one more page, Kurt. Get out one more page. Right there. Exactly. So in the past, we've had details underneath health improved initiatives, details under grant programs. You see that on the far left column under function and programs. Those are the expenses. We're open to expanding that if the trustees want. We were just already at 13 pages and figured maybe we would start with a summarized approach, as well as, I'm going to point out when we get to the supplemental schedule, I think you can see the data that you want on the other statements as well. So just floating that. But this is a very summarized statement, and it's upside down from what you're used to seeing. Expenses are on the top, revenues are on the bottom. Geeky accountants. The best part of this, in my opinion, is page 56, when we have to then reconcile why the two statements differ, which is informative. It does provide some color as to why the statements differ numerically, but so that's there as well. Maybe more importantly to the trustees, and then still included in the packet on page 61, is the budget to actual, which does show a true spend against budget and in with the pillars. And that's the common presentation that hasn't changed month over month. That's the 50,000 foot view of spending by pillar and by line item. And then the last page is in addition as well. It's just a year-to-date representation of the opioid management program. I'll use that term.
I think if we maintain page 61 in there, that should answer all questions and not have to add additional pages.
I think so.
Because that has all the extra detail in it.
Right.
Yeah.
And also on page, even though there's a report depreciation and leases, you do get a better detail of the statement of revenues and expenses and changes in fund balance of things such as fans and CHP, the things that you're used to seeing, so that can maintain its integrity too.
Yeah, maybe move that to the front so it doesn't get lost in all the other stuff.
Unfortunately, the order is
There's a specific order that it has to follow.
I move we change the specific order.
I'll let you take that.
We'll pass it on in another second.
I'm jumping up, Vice President, you're too late. We do have the ability to change the format of presentation, it's not just things. We just had to change the format of presentation of the compilation report as well. So I just want to, if there's any suggestions, and Kurt, that's a true request, we can do that, and we'll just represent that in the compilation.
You can just toss us
I
on page 62.
think we keep it the way we have it.
I will not go into this depth every single month. It was just the first presentation in this manner, and I just wanted everyone to know, both in the public and in the trustees table, we are in full compliance. Everything is in the sunshine. We are operating exactly how we are supposed to and reporting it as well. We do have the ability to modify that so that it's better and more useful information for the trustees too.
Is there any questions on the financials? All right. The financials as presented.
Motion.
We have a motion from Rusty, a second.
Second.
We have that from Harvey, and all in favor?
Aye.
Motion passes. Thank you, Matt, very much. Old business, do we have old business that we would like to bring up from the previous meeting or previous meetings?
What's happened to the parking lot? Is it done?
Kurt?
No, Harvey, you've been involved in that.
What's that?
Regarding the parking lot in Kimley Horn.
So last month, they brought it in, we voted last month to go forward, and they were given instructions to get the design done. They said, what did they say, 90 days, and have it ready for bid by midsummer, and then tomorrow morning, I'm meeting the surveyor out there to shoot the existing sewer line, because they don't have that on the plan, and it looks like the inlet and the sewer line are right on top of each other, so. Anyways, we'll do that tomorrow. Once they have that, I should finish up their plans, and then they should have them ready. And I'm going to give them a list of some local contracts to go with their list so that they can get it up for bid. And I think that's it, right?
Yep, I think that covers it.
I have a general question. I mean, seems like a fair amount of effort for, so personally, I didn't get a ton out of their speeches. It's just too much, too fast, too many numbers, and didn't know if perhaps there was some, maybe we could talk about it at a workshop, but, I don't know where they live or come from. I just hate wastes of time, especially when it's, causing someone else to travel across the country to do something. If we're not getting any benefit from it, maybe we'll have to rethink, and maybe it's just me, but, is there a better use of their time or better use of, the horsepower that they could bring to the table? If they're willing to come here and just, talk for 5 minutes.
Well, we have previously, used to come every quarter,
Yeah.
and we've cut it down to twice a year.
Yeah.
And I believe that there is a requirement that states that they do need to come in person. Is that correct?
I believe it is off the top of my head, but I'll check
Yeah.
into that and make sure.
Okay.
I
Well,
mean,
that's part of the contract. that's part of the
Yeah, they
contract.
agreed
Yeah.
to do that.
And maybe it's just,
Maybe what might be helpful would be if we could get their presentations installed in Boardable.
yeah, I mean, I'm trying to follow along with something and stuff like
It's
that.
not in Boardable because we don't get them until later.
They're not, they don't match.
It is immortal.
They don't
Is it?
match.
Yeah.
Okay,
They
they
came
did
in-
not match?
No, the one in the Graceville, I was looking at this one, and you guys were on different pages, and I finally had to go to this to find it.
Oh, it's different, yeah.
Oh, okay.
It wasn't matching.
We
I'm
didn't get
sorry,
it till
Kimberly, I
April
didn't think it was in there.
We didn't get till April 25th.
Right, which was Friday, right?
Yeah.
I have a suggestion that they should have the same format, three of them, right? Everybody has a different format. So one guy's.
You can say you can just say good stuff, whatever you want to say, yeah.
Yeah.
Yeah, I mean, this way we can follow the formats and say that they're comparable, but
That's why.
At the end of the day, Wilshire's doing their job, which I think they are.
Yeah.
And the three firms are all in line, because they're
Right.
keeping it in line, and so when we get here, they're basically just saying the same thing 3 times, but.
But they have their opportunity to talk about their strategy.
I mean, I
There's
think,
no
for me,
strategy.
they're all smart.
They're just following the guidelines by
The
Wilshire.
IPS,
Yeah.
but within that IPS, they have some ability to make different changes than the other two do.
We just challenge you next time to come up with some good questions beforehand.
Yeah, well, I think it would be cool, I mean, they have a lot of horsepower and resources that we don't have, and I'd be really interested in listen more to just, strategy or, look, if we look at the last year in review, here's what we could have done differently, here's maybe what y'all have to consider doing stuff in the future. Just, I mean, they're the smartest guys in the room typically when they walk in.
They think.
Huh? I get it. Well, someone at their company is, and so if we could just benefit from their wisdom somehow, as opposed, it just feels like they're kind of reciting numbers that we already have. They seem to be conflicting, that was a different issue, but I just think that it'd be, as opposed to being more tactically focused, maybe it's just more strategically focused, something that can educate us, teach us something.
Well, when we talk to Wilshire, and
Mhm.
the next time when we talk to them, and let's just see if they can help us be more creative. So instead of hearing 3 things
Okay.
over and over, maybe we could have them each pick
Topic.
a section.
Okay, all right, I will have a conversation with Nathan.
I mean, because at the end of the day, we're probably gonna, they're gonna live or die based on what Wilshire says, not what they say.
Precisely.
So
Mhm.
Yeah.
convincing us of something is just, it's not useful, a good use of time.
Well, I think that once we see the dashboard that Wilshire has put together will be very beneficial for us all.
Yeah, 100%.
And it'll standardize it a little.
Yeah, and it will. And they're trying to put all their ducks in the same row to get there.
I just don't know, I think when there's a trigger date, like, okay, this is not working out, what are we gonna do? What's the next plan? But I don't know where that is. For the vendors.
Yeah, and, that's what caused us to make changes previously with outsourced CIOs, where we would ask them about their strategy during these meetings, and we would say, oh, you're severely underperforming against the benchmark, you have been for the last 3 quarters, what's your plan? And then when the plan wouldn't pan out, we'd say, okay, it's time to look for someone else, because they would stick to that philosophy.
They've never beat the benchmark last 8 years in a while. None of them have come. Maybe a
We were doing great until last month.
Yeah. It depends on which investment equities we were.
I mean, we're in the
Yeah.
long haul, so we can't.
That's right.
We can't let these little moments.
That's correct.
We've gone through it before during COVID, that was one of our worst ever.
Mhm. Other discussions that we need to talk about? Hearing none? Then we're adjourned. Thank y'all very much.
Thank you.
Well,